We live in a world where the markets move at the speed of light, where brand new investors YOLO into meme stocks like GameStop, and fortunes are seemingly made in the blink of an eye. Is this the way real wealth is made in 2024? Maybe for a select few, but for the rest of us, a better, a safer, a more consistent approach is available. And if done right, it will be, not might be, it will be the reason you achieve true financial independence. Instead of your strategy bending to the will of time, here, the time bends to your strategy. Imagine having the power to peer into the future, to plant seeds that could grow into mighty oaks faster than normal. It's where patience meets ambition, where you can leverage time itself for exponential gains. What's up, you guys? Welcome back to the Average Joe Investor channel. Today we're talking about LEAPS options, which is something we have not talked about yet on the channel. However, I'm always reading, always doing education, trying to learn and become a better investor. And sometimes that means diversifying the different strategies you use in your portfolio. So I read a lot of books, and the one that I can really credit to diving deep into the strategy is called the 10-Minute Options Trading and ETF Investing, Rapidly Build Wealth, Retire Early, and Live Free from the Worry of Market Crashes by Travis Wilkerson. He has a YouTube channel. He's also on X, so I definitely recommend reading the book and following him in those locations. So what are LEAPS options? Like I said, they do have an official term, long-term equity anticipation securities, or LEAPS, which is a terrible acronym, by the way. But for the average Joe investor, you should consider them to be options, but they're long-term options, not, daily, weekly, monthly. We're talking 6 months, 12 months, 18 months, 24 months, even as far out as 30 to 36 months. Now, the first thing you might be thinking of, if you're a regular member of this community, is, hey Joe, you talk all about selling options. Why are we talking about buying options? The big reason why I don't normally buy options is because with buying options, you have to get market direction correct. Buy a call option, the price of the stock must go up for you to win. And in many cases, it has to go up by a lot for you to win. Whereas if you're selling a call option, the market can go down and you win. It can stay flat and you win. It can go up a little bit and you win. Selling options generally leads to higher probabilities of winning. And the reason why buying options generally doesn't work is because of a thing known as theta, which can be generally described as time decay. Every option contract is made up of both extrinsic and intrinsic value. Intrinsic value is how much the option is worth right now today if you were to exercise it. Whereas extrinsic value is derived from how much time is left until the option contract expires and the potential change or likelihood of the price going up or down. Some stocks have high levels of volatility, which leads to more extrinsic value. So think of it, on one end of the spectrum, you've got a stock like Tesla, which has high levels of volatility, could go up by a lot, both up or down. And on the opposite end of the spectrum might be a stock like McDonald's or Procter & Gamble, Genuine Parts, large companies that don't have significant movements on a day-to-day basis. Time decay affects every single options contract out there, but not in the same way. Here's a look at what option time decay looks like over time. As you can see, it's got an arc to it, and at the beginning of the time frame, there's really no change in the time value. It's very, very minimal. But as you get closer and closer to expiration, the amount of time decay that occurs speeds up significantly. So buying short-term options means that you have to get the price direction correct, number one, and number two, you have to get it done quickly. Otherwise, your option contract will lose its value. LEAPS contracts, or long-term option contracts, when bought, minimize this concern because there's such a little amount of theta decay or time decay. So let's dive into why we would consider utilizing LEAPS options in our own portfolio. Number one, LEAPS option contracts are far more capital efficient than owning shares of the underlying stock. Let me share with you what I mean. We're looking at the S&P 500 here, ticker symbol SPY, currently priced at $580.83. And if we wanted to own 100 shares of the underlying stock, we would have to take $580.83, multiply it by 100, equals $58,083. That's a lot of capital, and most people don't have that sitting aside ready to invest. But what about owning a LEAPS option contract? We're looking at the option chain for the S&P 500, ticker symbol SPY, and let's just, for keeping things simple, let's take a look at just an at-the-money contract, okay, right at the current market price, which you would say might be the equivalent, potentially, of buying 100 shares at the current market price. So here you can see that the current price for 585 is between 74.67 and 78.50. Now these numbers are based on per share, so you have to multiply them by 100. So we'll go back over to our calculator. We'll take, right in between there, we'll call it 76. So 76 times 100 means that you can now control one option contract for the S&P 500, which is the equivalent of controlling 100 shares of the S&P 500 for only $7,600 as opposed to $58,000. And this contract we're looking at here, which expires on December 18th, 2026, expires in 781 days, which means you get to control 100 shares via one contract for the S&P 500 for over 2 years. And it's only going to cost you $7,600 as opposed to $58,000. So far more capital efficient. Second big reason why you should consider utilizing LEAPS options is the growth that's possible with LEAPS options is much more significant than you would receive with the share growth if you owned just the shares. To illustrate this, we're going to look at this backtesting software that we have through Market Chameleon, which is fantastic, by the way. And let's assume that 1 year ago today, when the market was priced at $4.10 per share, let's say we went back a year, okay, back in time, and we purchased the $4.10 contract right here. Okay, 410 contract right here for the S&P 500, which expires January 16th, 2026, which is the farthest dated contract available at this time. Okay, today is 10/27/2023 right here, and we're looking at the January 15th, 2026, or excuse me, January 26th contract from 2026. So what we're going to compare here is investing $6,400 into one S&P 500 LEAPS contract expiring January 2026. And we'll also invest the same $6,400 in the S&P 500 to see how the two different strategies compare. All right, so we fast forward here. Now we're on 10/28/2024, which is today. And now the price of the S&P 500 is much higher. We're at, what, $5.80 and 66 cents. We'll put aside the idea of dividends for 1 year, but just know that that would incrementally increase the per share value because you don't earn dividends when you own LEAPS contracts. You just have the contract value. At that time, originally, if you'd taken $6,400 and divided by the price per share of $4.10, you'd be able to purchase 15.6 shares of the S&P 500. If you take those same 15.609 shares and multiply that by the current price, $5.8066 times 580.66, that $6,400 would now be worth $9,063. And that is a 42% increase in the value of your shares, which is great. No one's disputing that. But how did that purchased S&P 500 LEAPS option do? Well, let's go back to 410 here in this backtesting software. Right here. That contract, which we initially purchased for 64, is now worth 190, we'll call it 191.50. We'll take 191.50 times 100. It's $19,150. You heard that right. $19,150 from an initial investment of $6,400. You take $19,150 minus $6,400. It's a gain of $12,750 divided by $6,400 is essentially a 200% increase in the value of our LEAPS contract, whereas we only got a 41% increase with the shares of the S&P 500. That's the leverage, that's the beauty and the potential opportunity, that exponential growth that we can get if we purchase LEAPS options. Now, obviously, the S&P 500 went up quite a bit during this time frame. So just know that the LEAPS contracts that we potentially purchase are going to be dependent on the actual underlying value of the S&P 500 or any stock ETF in going up during that time frame. But just know that when it does go up, you win massively. You win huge. The amount of money that you have at risk is far less, right? We talked about that with the leverage, right? Far more capital efficient. If the worst case were to happen, you will lose all of your investment. But remember that with a LEAPS contract, you're investing far less than if you actually purchase 100 shares of the stock. You don't get to participate in dividends. So I would think it would be generally a poor choice to purchase stocks that are high dividend yield payers with a LEAPS contract unless you feel that it's far undervalued because you're not going to get those dividends paid. You're not entitled to dividends. If you could lose all of your money, right, because your time frame with the LEAPS contract is defined. You can hold it as long as you want to, but up until expiration. And if the value of the stock is below your strike price, whatever it is, that contract's going to expire worthless and you lose everything. In general, you can expect your LEAPS contract to go up by more than the stock and go down by more than the stock if you were to own the actual shares. And that's the beauty of utilizing LEAPS contracts, purchasing them on index ETFs, such as the S&P 500, such as the NASDAQ 100, such as the Russell 2000. These are highly diversified ETFs. And what the market has shown over time is that over time, markets go up. There are going to be times when there's volatility, times when the markets drop significantly, but over the long term, stocks go up in value collectively as part of an index. So how much money should you invest in a LEAPS contract or any types of LEAPS contracts in your portfolio? In general, I've seen a number of different people say different things, but I think in general, at worst, the maximum weighting in your portfolio should be 20%. with LEAPS contracts. In fact, it should probably be lower, closer to 10%. There's already a significant amount of leverage on these contracts, and if you overweight your portfolio, you run the risk of a significant drop in value. And if the worst were to happen, if we experience another 2008 crisis where stocks stay depressed for a year or two or three, you're gonna have a situation where your portfolio, if it's overweighted, drops 60, 70, 80%, and because it's not in shares and it was in contracts, it could end up not being recoverable. Another thing you should highly consider doing if you utilize LEAPS contracts is not holding them all the way until expiration, because we talked about theta, time decay, right? The fact that these contracts are constantly losing value over time, and how much time is left until expiration factors in significantly to how much extrinsic value or time decay is lost. Contracts that have a few days, a few weeks, a few months are going to lose value, erode faster than contracts that still have a year and a half until expiration. In general, especially due to taking advantage of tax benefits as the laws are currently written right now, you want to take advantage of long-term capital gains rates if you can, which means you have to hold these things for at least a year. That's why generally if you're going to utilize LEAPS contracts, you should consider long-dated contracts as far out into the future as you can. Another key thing that is talked about in a lot of videos about LEAPS contracts is you should do them in the money. And by in the money, I mean where the strike price is much lower than the current market price. This gives you a little bit of intrinsic value, and it results in a little bit less volatility. And if the markets do drop over time, it will have a lower impact on your portfolio value. Now, there's nothing wrong with in the money LEAPS contract, and there's certainly a viable strategy to using them. However, if we're talking about doing this on the S&P 500, the NASDAQ 100, the Russell 2000, I do think that there's value in utilizing maybe an at the money strategy, or at least diversifying across in the money, out of the money even a little bit, and at the money, because markets over time have shown to go up. Now, all of this sounds fine and dandy, right? Oh yeah, LEAPS contracts, they sound amazing. Lots of leverage there, right? Far more capital efficient than just owning shares. But I think there's value in saying, how have they performed over the past 5 years, 7 years, 10 years? Have these actually worked in the past? Good news is we have great backtesting software that we can utilize to see what historical option chains look like, what those values were, how things would have worked out if we'd started this strategy in the past 5, 7, or 10 years. Which is why you're gonna want to jump to the next video right here, if of course you're watching this video after November 1st, 2024. Also, make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many comments as possible on the day I post a new video. I'm always curious to know your feedback. That's all I got for you guys. Have a great rest of your day, and thanks for watching.